Welcome to the market alert for June the 28th, 2016. So yesterday in the pre-market session, you can see the Dow moving down 150 points before the market found some support, then moved higher just before the open and then resumed the down move there. We had the one signal that produced just over 20 points, and then the remainder of the session as the market found support at 17,100 remained sideways, and then sent a note out around this time. Saw the market coming back, stuck in this sideways range, so sent a note out to say forget it for the remainder of the day. And then after we had two losing trades because of how sideways the market was, so it was a good call to leave things alone. And it's no surprise really, because that's what's happening at the moment. You're getting a bit of volatility in the first part of the session, and then we tend to find support with either the plunge protection team or somebody doing something somewhere just to support these markets. I've said before, they're not allowed to go into free fall. In the daily chart, let's just get some perspective on the so-called global markets crashing. If you have a look at this chart, this is the daily chart. You've got the Federal Reserve increasing interest rates by just 0.25%, having been on emergency interest rates, and we in the UK are still on emergency interest rates back to the banking crisis. You can see there the market moving 2,000 points lower until Yellen on this day had a word with Carney and Draghi, and then the market moved all the way back 2,000 points and has been there ever since. We haven't lost 2,000 points, the market's just made a correction and pulled back. So all of the histrionics in the mainstream press, again, is completely out of touch with the reality. What's far worse than the Brexit situation is trying to normalise the markets and increase interest rates. They can't do it because of the amount of bonds that they have at such low rates. And then, of course, the second part of that is that when it comes to servicing the debt with new bonds with higher rates, it's going to cost more, and they can't do that either. And that's why they're stuck and trapped in this this circle of trying to raise rates and then trying to service the debt with the tax revenues and no growth in the economy, fighting against it. So it's beggars belief really, but this is how the mainstream media interpret all of this. It's all scaremongering and whatever. When you look at the charts, you see exactly and precisely what's going on, and apply a bit of common sense and logic to it, understanding interest rate and bond relationships and just some basic economics of what relationships between different instruments and different market indicators, inflation, interest rates, etc., etc. It's very easy to read and also forecast. So again, this is overblown. Yes, we had a big day down. We've had big down days before. As you can see there, last August, exactly the same. Nobody really mentioned it in the media, but we have the Brexit, which they can now strap onto the back of it, and it makes it look like there's financial Armageddon going on. I'm not saying that there isn't going to be. Of course there is. This market's going all the way back down to a fair value anywhere around 10,000 or below. It has to, because it's an asset bubble that's been pumped with QE money. But they're doing their damnedest to keep this up, and the reason for that, of course, is people's pensions. If they see that people are losing money in the stock market, then it's going to cause all sorts of anxiety problems. And in the US, that's the last thing they need at the moment as they run up to the election with Trump and Hillary as well. So everything is being done to keep this market in the highs. News-wise today, what have we got? We've got the EU Economic Summit. So Draghi is going to be speaking again at 11:15. The final GDP for the US is out at 1:30, and then 3 p.m. consumer confidence. This is going to show, well, it's forecast to show a slight increase. We'll wait and see. The trend for this has actually been down, and that's because people are up to their eyeballs in debt. So to maintain that confidence, they have to keep borrowing more in order to do it. And the implied volatility, 1744. You can see this coming off the highs yesterday of 1884, I think it was yesterday. So again, no surprises. The market's finding a bit of support there. Before the market does make its bottom, though, you'll be looking around over the 20-25 area in the implied volatility, find a bottom, and at that point, no doubt, there'll be a decrease in interest rates in the UK, the Eurozone, and in the US to actually bring that support to the market. We'll then get another false rally to the upside before we get the real start, because the central banks are running out of ammunition to keep these markets in these levels. It's as simple as that. It won't be long before they propose helicopter money, and that's giving every citizen a few quid every month. They had a vote on this in Switzerland last month, and it was voted out. But they are looking and getting desperate to keep this afloat. So there you go. That's this morning's market alert and what's going on, really going on behind the scenes, completely different to what you're reading in the mainstream. Right, that's it for today. If I see anything else, I will let you know. Other than that, have a great day, and as ever, thanks for watching.